Good day, classmates. Today I am here to report on the four topics we discussed during our first quarter of finance, accounting, and business management. The first topic we discussed was the statement of financial position, also called the balance sheet. The balance sheet is a financial statement that provides a snapshot of a company's financial health at a specific point in time. It includes assets, which is what the company owns, liabilities, which are the company's debts, and obligations, and equity, which is the residual interest in assets after deducting liabilities. The balance sheet follows the equation assets equals liabilities plus equity. It's used to assess a company's financial stability, obligations, and overall financial position. On to our second topic, which is the statement of comprehensive income. It is a financial statement that provides a comprehensive view of a company's financial performance over a specific period, typically a quarter or a whole year. It goes beyond the basic profit or loss reported in the income statement and includes other comprehensive income items. It consists of a lot of things. Revenue includes the company's total sales or revenue generated during the reporting period. Expenses are the cost incurred by the company to generate revenue. Common expense categories include operating expenses, interest expenses, and income tax expenses. Operating profit is the result of subtracting total expenses from revenue. It generates from the core business operations of the company. Total comprehensive income is the sum of the operating profit and other comprehensive income items. It provides a more holistic view of a company's financial performance. The statement of comprehensive income is a significant improvement over the traditional income statement because it captures a wider range of financial events that impact a company's overall well-being. Our third topic was about the statement of changes in equity, also known as the statement of equity. It is the financial statement that provides a summary of the changes in the company's equity or shareholders' equity over a specific period. It's an essential part of a company's financial reporting and it helps stakeholders understand how equity has evolved. Beginning equity is the starting point for the period covered by the statement. It represents the total equity at the beginning of the period, which is typically the same as the equity from the end of the previous period. Contributions from shareholders show any new investments made by shareholders during the reporting period. It includes the issuance of new shares or additional contributions to the company's capital. Net income or loss reflects the profit or loss generated by the company during the reporting period. If the company made a profit, it increases equity. If it incurred a loss, it decreases equity. Other comprehensive income, or otherwise known as OCI, is similar to the statement of comprehensive income. This section includes items like unrealized gains or losses on investments and foreign currency translation adjustments that impact equity but are not part of the net income calculation. Dividends paid is if the company distributes dividends to shareholders. This section shows the amount of dividends paid during the period. Dividends reduces equity because they represent a distribution of profits to shareholders. Ending equity or ending capital is the total equity at the end of the reporting period, calculated as the sum of beginning equity, contributions, net income or loss, OCI, and changes in equity components minus dividends paid. The statement of changes in equity is crucial for stakeholders, especially shareholders and potential investors, as it provides a detailed account of how equity has evolved during the specific period. It helps in understanding the sources of equity grow or decline, such as investments, profits, losses, and dividend payments. And finally, on to our last topic for this quarter, the statement of cash flows. The statement of cash flows is a critical financial statement that provides an overview of how a company generates and uses cash during a specific period. It's divided into three main sections, each focusing on a different aspect of a company's cash movements. Operating activities. This section reports cash flows related to a company's core operating activities, such as sales of goods or services. Investing activities. This section deals with cash flows related to investments in assets and securities. Financing activities. This section covers cash flows related to a company's financing and capital structure. The statement of cash flows is a vital financial statement because it offers insights in a company's liquidity and ability to meet its short-term and long-term obligations. It helps stakeholders understand how a company is managing its cash resources and whether it is relying on external financing or generating sufficient internal cash flows to support its operations and growth. And that is it for my brief report on all four topics we discussed this first quarter. Thank you for listening, and I hope you understand.